Hello everyone. Today I am going to start a new topic related with ratio analysis. Topic is profitability ratios. Profitability ratios are calculated to analyze the earning capacity of the business, which is the outcome of utilization of resources employed in the business. Profitability ratio analyze profit with reference to either sales or assets employed. Various ratios calculated for profitability analysis. First, gross profit ratio. Gross profit ratio is computed to have an idea about gross margin or markup. It is computed as follows: gross profit ratio equal to gross profit by net sales into 100, where net sales means total sales minus sales return. Gross profit refers to net sales less cost of goods sold. Cost of goods sold is determined as follows: cost of sales equal to opening stock plus purchase plus direct expenses minus closing stock. Operating ratio. It is computed to analyze cost of operation in relation to sales. It is calculated as follows: operating ratio equal to cost of sales plus operating expenses divided by net sales into 100, where operating expenses include office expenses, administrative expenses, selling expenses and distribution expenses. Operating profit ratio. It is calculated to reveal operating margin. It may be computed directly or as a residual operating ratio. Operating profit ratio equal to operating profit by sales into 100, where operating profit equal to sales minus cost of operation. Expenses ratio. Sometimes an attempt is made to analyze individual expenses item which form part of operating expenses. It helps in detailed analysis of operating ratio. Expenses ratio equal to expenses by net sales into 100. Next, net profit ratio. Net profit ratio equal to net profit after tax by net sales into 100. Next, overall profitability ratio. This ratio relates profit to the amount of funds employed. Basic formula is profit by investment of funds into 100. Depending on the definition of investment, profits are defined. For example, first, where investment refers to equities shareholders fund, profit is considered after preference dividend. Second, where investment refers to shareholder funds, profit before dividend is taken into account. Where investment refers to long-term funds employed, profit before tax and interest is compared with capital employed to calculate return on capital employed. Return on equity shareholders fund. Formula: return on equity capital or equity shareholder fund equal to profit available for equity shareholders after preference dividend divided by equity share capital into 100. Return on shareholders fund. Return on shareholder fund equal to profit after appropriation divided by share capital plus reserve and surplus into 100. Return on capital employed or ROI. ROI equal to profit before interest and tax divided by capital employed into 100, where capital employed equal to fixed assets plus working capital or long-term debt plus share capital plus reserve and surplus minus fictitious assets or miscellaneous expenditure. Other measures to study the profitability are as follows. Earning per share or EPS ratio. EPS ratio equal to profit available for equity shareholders divided by number of equity shares. Dividend per share. Dividend per share equal to total equity dividend divided by number of equity shares. Dividend payout ratio. Dividend payout ratio equal to dividend per share divided by earning per share into 100. Dividend yield ratio. Dividend yield ratio equal to dividend per share market price per share into 100. Price earning ratio. Price earning ratio equal to market price per share divided by earning per share. And last is trading on equity or capital gearing ratio or leverage ratio. Formula. Trading on equity or capital gearing ratio or leverage ratio equal to preference share capital plus debt divided by equity shareholders fund. Thank you.